Everyone keeps asking me every day, what's your strategy, Rahman? How do you trade? What's your risk reward? What's your favorite setup? All these questions I cannot answer, unfortunately. My system is tailored to me specifically. I cannot give it to you exactly the way I trade because it would be very useless, because at the end of the day, the way I trade, it's not going to help you. Everyone wants to know my exact strategy step by step, but there's a problem with that. If I give you my exact strategy step by step, you will not be profitable by using it. It's not going to work. Trust me when I say that. I've tried other people's strategies. That is the main flaw in people's courses. When people sell courses, they oftentimes give you a strategy, step by step strategy that you should follow, and usually that strategy is for the person who made the course, it's for themselves. They used it, they saw success, so what did they do? They give it to you so you can use it as well. But guess what? It doesn't work like that. I have been trading the Nasdaq for nearly 2 years now. I have experience on the Nasdaq. I can see when price is getting overextended. I can see when price is going to retrace. Obviously I can't call the top or the bottom. That is physically impossible no matter how much experience you have, but you just build this intuition for the pair. That's why I always tell you, trade one pair. Do not trade more than one pair. One of the key things to success in trading, in my opinion, is one pair, one time session, and one trade a day. That's all you need. If you want to genuinely succeed, stop trying to place a trade on every single pair. Trading view, it's not gonna work. You cannot master every single pair. Everything moves different. The euro will move different from the pound. The Aussie will move different from the yen. It's like you cannot compare these pairs. Don't get me wrong, there's correlation between some pairs. You can compare some pairs to each other to place a trade on one of them, but that's, I would say, a bit more complicated for beginners. I would not recommend you do that. I highly recommend stick to one pair. In my case, I've always been fascinated by the indices, traded a bunch of indices, and at the end I came to the conclusion that I should trade the Nasdaq. Nasdaq is currently my favorite pair, and I've been trading it for the past 2 years nearly now. In today's video, I'll show you one of my favorite strategies that I took from ICT. ICT's concepts are really beneficial for beginners. Anyone trying to get good at trading, I highly recommend you check out the 2022 mentorship ICT and his other videos to get a good grasp how trading works. So the way I looked at ICT's concepts is, it's not a copy and paste model. You cannot just take ICT's concepts and just copy them exactly on the charts and suddenly see some crazy results and you're going to be a good trader. That's not going to happen. You need to take ICT's concepts, you know they work, take the concepts and now build upon them. Strategize how you're going to optimize the efficiency of the system, risk to reward, all these things you need to calculate before you go into the live markets. In today's video, I'm backtesting an ICT model I have made myself. I took ICT's concepts, I took his time window and everything, but I've given my own twist to the system to make it profitable and very easy to use for beginners. I've made it as mechanical as possible so that anyone watching this video can literally open their trading account and place a trade every single day without any experience. It's as easy as that. There's some key thing, there's a bunch of key factors that you need to remember. Make sure you remember these key factors. The risk to reward is going to be 1-to-1. I've been preaching 1-to-1 risk to reward since as far as I can remember. 1-to-1 is the best risk to reward you can use. Do not increase it, do not decrease it. Use 1-to-1. We're going to be using the silver bullet time window, which coincidentally enough is the time window I've been using even before I knew about ICT, which gives me even more confidence now that that time window definitely optimal for trading the Nasdaq or anything else, matter of fact. So we'll be using 10 a.m. to 11 a.m. We'll be placing a trade as soon as we see the first fair value gap on the 1 minute time frame after 10 a.m. First fair value gap on the 1 minute. We will place a limit order on the fair value gap and we will have a 30-point stop loss. Yes, 30 points. Don't make it 50, don't make it 10, 20, 30. You might ask, why 30? That's my system. My system uses 30 and has been highly profitable for nearly 2 years now. And 30 points, I've noticed on the Nasdaq, gives you an edge. It gives you enough breathing room to include previous structures into your stop loss, so that just in case price moves back into it, you'll be fine. And a 30-point TP is what we're using to make sure that it's a 1-to-1 risk to reward, obviously. So I have now final 2 points. My first point is, do not do anything stupid. Look at the chart, look at the criteria I've given you, and don't do anything stupid. Just follow those rules simply. Now I'm telling you to follow those rules, but obviously every system needs to be catered to the trader himself. Just because this system, even though it's mechanical, it works for me, right? I have experience on the Nasdaq. I know how to move around. I know if I need to maybe not trade on a particular day. A beginner might still take a trade. Maybe there's a news day and you're going to take a trade. Maybe price is super extended and you're going to take a long on it, for example, because you don't know better. That's why I'm telling you, experience is important, and do your own back testing, forward testing, optimize the system to your needs. But overall, the system, the way it is, it should be able to pass prop firm challenge. There's 2 ways to pass a prop firm challenge. Number 1, conservative. Number 2, to high risk. Conservative is 0.5 to 1% risk per trade. This will take you on average more than 3 months past phase 1 and hopefully phase 2 as well. However, if you take the high risk approach, which I recommend, but let me explain. Trade with 2% risk per trade. Now, on most prop firms, you're given 5 maximum consecutive losses from break even before you blow your account. Now you might be asking, I don't want to blow my account, and I don't want to wait 3-4 months. That's what I'm going to tell you now what to do. You need a set budget for prop firms. Let's say you have $5,000 that you want to give yourself for prop firm challenges. Now divide that by 5. That's $1,000. What challenge can you buy with that? Most prop firms will let you buy 200k challenge, just about $1,000 or less than $1,000 per challenge. Now you have 200k, 5 challenges. Risk 2% on the first challenge. Let's see how that goes. Worst case scenario, you fail that, you have 4 more. Repeat. That probability with an edge of you getting 5 consecutive losses every single challenge that you start 5 times, it's very low. You're not gonna do that. Back to my final point, that was a secret about the Nasdaq. When you're gonna be trading with 30-point TP on the Nasdaq, remember, if price has not hit your limit order but it has hit your TP level, void that trade. That trade is now invalid. You will not be entering a trade if price extends your TP without retracing back into your fair value gap or your limit order in general. I've derived this conclusion from my own experience on the Nasdaq. Most of the times, if your limit order doesn't get hit, price extends to your TP. What happens is, it's like a rubber band. Price goes to your TP, snaps back. Now it's not gonna stop at your entry and then somehow stretch back down to your TP. It's gonna bounce all the way back to your stop loss. So keep that in mind. Now let's get on the charts and let me show you how this strategy works. Alright guys, so here we are on the charts now, and I will show you exactly what I meant with every single rule that needs to be followed and how this strategy can actually be used past any prop firm challenge if used really well, exactly like I've explained it. And the thing is, I will most likely make a documentary series where I will take a 100k or 200k challenge with one of the prop firms and use the exact same strategy, and I will document the whole process and journey on how I'm managing my trades so you guys can see that this strategy does indeed work if it's used correctly. Bear in mind that this is currently just something that for you to work on. There's many things that can be improved, as I will show you now on the charts. Actually, backtesting strategy. So I've gone here on FX replay. I've gone back a couple of weeks, it looks like. So if we go to the next day open, 18th of September. Now what we have to do is we have to wait for the first 1 minute fair value gap to appear on the chart here. As you can see, first a bearish fair value gap has appeared. What we do now is we will place a limit order right at the fair value gap right here. And now the key thing is 30 points is how big your stop loss needs to be. I know you will say maybe that's too big or whatever. I know ICT might suggest a much smaller stop loss. Some people will tell you to place it only above the previous candle, but this, from my experience on the Nasdaq, 30 points is a very optimal amount of breathing room to give you a trade, especially on a 1-to-1 risk reward. Many people will tell you to use this for 30 with a small stop loss, or 1-to-2, 1-to-3 risk reward, but that's not what we're doing here. I've been preaching since day one that 1-to-1 risk reward is what works the best. That's why I'm recommending everyone here uses a 1-to-1 risk reward and experiments with it. So let's fast forward this and see what happens. As you can see, this is a loser. Next day we'll do the same thing again. As you can see, this was the first fair value gap that happened right here. Place our limit order, 30 points and 30 points TP. We let that run. We get triggered into our order and TP gets hit right here. Remember that if no trade is entered, or if you are in a trade but 4 o'clock has been hit, 4 o'clock is UK time, this will be 11 AM New York time. If that time gets hit, you need to exit the trade and close any trades if you're in the trade already. That's a key thing to remember for this strategy. This is just me using ICT's teachings in this case, right? Obviously I'm telling you 30 point stop loss, but overall this is ICT's classic silver bullet style strategy. I've just made it as mechanical as possible so that anyone at home can follow me in this video and hopefully get funded with this. So let's go to the next session right now. This is the next session right here, 10 AM New York time. We will wait for the first fair value gap to appear. Here we go. That's why using an indicator that shows you fair value gap is so important. Look at this. Most people would have missed this fair value gap if they were looking at it with just their eyes. But there's a fair value gap right here. 30 points again, stop loss. The beauty of 30 point stop loss is that most of the times if your entry is timed correctly, 30 points on the Nasdaq covers quite a lot of the good areas. So in this case, as you can see, we are covering pretty much the previous highs here, and giving us still some room above that, just in case price decides to test these levels up here, right? That's why 30 points is such a good sweet spot for stop loss. Been using that for over 1.5 years now. So we get triggered into the trade, and this is another winner right here. I will be mentioning another very important factor about this system soon, if it shows here on the charts the scenario I'm looking for. So first we wait. Okay, so this was the first fair value gap right here, long position right there, 30 points and 30 points to the upside. Okay, this is exactly what I was waiting for. As you can see here, if you see a fair value gap where you want to place your trade and price leaves that fair value gap before coming back to it, and it hits your TP level before, right, you do not want to take that trade again if that happens. In this case, I think we're still like very little away from it. Okay, exactly, as you can see here, it hit that, right? So we won't really want to take that trade. As you can see, most likely price will not trigger us in anyways here. But overall, the logic behind this is, if price is too overextended already, the probability of it coming down to your far away fair value gap and then coming back up 30 points is unlikely. Due to the overextension, most likely price is going to retrace heavily downwards, and there's a high probability they will not come back up again. It's like a rubber band, right? You stretch the rubber band too much, it's gonna literally bounce back, and it's hey, you stop loss, entry plus stop loss. Low probability of it bouncing in the middle and coming back up. Just remember that, and bear in mind this is one of the key principles I've been using in my own system the whole time. Alright, so next day, let's see what we get here. Alright, we got a bullish fair value gap right here. Our limit order will be placed again, 30 points, and now we see what happens. We got stopped out right here, that's all good. This is the next day, and we have a bearish fair value gap right here, 30 points. Look at this, beautiful. The way this stop loss is covering the previous major high here is just really good. Let's see if we get triggered into this order. Perfect, this perfectly played out. But now imagine this was, seems like even if you had high risk reward here, it would have still worked. But make sure to not do anything stupid whatsoever. Listen to me explaining each rule carefully and then follow them to the T. Do not change anything. You're welcome to experiment with stuff, right? But do not change anything major in the whole strategy. Stick to the core principles that I'm telling you. So if you go to the next day here, let's see what we have here. And there we go, first bearish fair value gap. So we do 30 points, 30 points down here, and we watch this. Alright, this is the loser. Next day we get bearish fair value gap right here, 30 points, 1-to-1 risk reward as always, and we wait. As you can see, we have already hit that, so we will ignore this trade. I will still play out just for you to see. As you can see, in this case this would have played out, but over a long enough data set you will see that most of these trades do not play out. As you can see, look at this, price goes down here, it bounces back with such momentum. I would say a degree of luck is required in this case, where price just bounced back down again, right? There's no good reason for this to happen. Like, our stop loss is just here, we can easily get hit. What if the fair value gap was down here, you would have got hit. So it's like, do not risk these kind of things. And this is me telling you from over like nearly 2 years of experience now of me trading the Nasdaq only. I know that on the Nasdaq this is very common, especially with the 30 point stop loss and TP. This is a very common occurrence. Let's go to the next day. We have a bullish fair value gap right here. Let's play this. We got triggered into the order and we got stopped out. Let's go to the next day. Here we go, first bearish fair value gap. Look at this, 30 points covering the previous structure perfectly, 1-to-1 risk reward, and we go trigger into the order, and this is TP. Let's see next day. Okay, we have a bullish fair value gap right here, 30 points. As you can see, we've already gone above that. I'll show you just in case. See, this would have been a loser if we had not followed that rule I have explained before. Next day, we have a bearish fair value gap right here, 30 points again, 1-to-1 risk reward, and let it run. As you can see here, again, we'll ignore this trade because price left without tapping into the fair value gap and already moved more than our TP. Just treat it like this. If your TP is 30 points, that's pretty much how much you want price to move towards the direction of your trade. You don't want price to move any more than 30 points, no matter if you're in a trade or not. If price moves more than 30 points in your intended direction, then that trade will be just invalid. That's how I would say you should treat that. So here, let's see again, bearish fair value gap right here, 30 points, and the 1-to-1 risk reward. Let's see how this one plays out. So we got tapped in right there, and let's see TP go here right there. Play out just to see if TP will hit again. Yep, TP gets hit even if you're a bit like your entry was a bit bad, you will still hit TP right here. That's all good. Next day, let's see. Oh, there you go, bearish fair value gap right there, 30 points, 1-to-1. We won't be taking this trade anymore. Price overextended beyond our TP, and we don't get entry anyways, so that's all good. Next day we get bullish fair value gap right here, place our limit order right there. Guys, this is as mechanical a strategy you can ever get. Like, if you can't follow this correctly, optimize a system like this one, you're doing something extremely wrong with the way you're trading. I don't know if psychology is wrong or what you're doing wrong, because here emotions wouldn't be as heavily involved. Like, what is there that can go wrong? It's so mechanical. You're literally checking off the list a bunch of simple variables. Overextended, so we won't be taking this trade regardless. Alright, next day, let's see. First fair value gap shows it's here, bearish. We'll make this 30 points. 1-to-1 risk to reward as always. Always remember 1-to-1 is the best risk reward. We overextended, so we'll not take this trade. Even if we get tapped into it right now, this trade is invalid. See, this would have been a winner, but I'm telling you, over a long enough data set, this will play out in your favor. We get bullish fair value gap right here, 30 point stop loss and 30 point TP. Let's see how this plays out. We got tapped into it, and so I think if you were to use the high risk setup for this strategy in this time zone we just tested, like this session of 20 days I think it was, if you were to use the system I told you about, the high risk, so you're risking 2% per trade and you're buying a challenge for a prop firm that you can afford to lose 5 times in a row. So if you have $5,000 at your budget for prop firm challenges, that means you can buy 5 200k challenges, as one 200k challenge on average is around 1k. So in this case you can risk 2% on each of those accounts. You will run one account first, 2%, do this. As you can see here, you'll pass phase 1 in literally 20 days. I know most of you think, oh, 20 days is such a long time. Then you don't deserve to trade. You don't deserve to be making money trading if you think 20 days is too long. The market doesn't owe you anything. 20 days is nothing in the markets. Get that through your head. This takes time. 30 days, 40 days. I have been in a challenge. It's a funded engineer 500k challenge. It took me 3 months to pass phase 1. So you gotta put that in perspective. I'm not gonna complain it took me 5 months. I wanna have 500k at the end of the day. 1% gain on that is 5k. That's more than most people's average salary. So back to that strategy. Follow it like the way I've told you. Back test it. And if you do end up choosing the high risk setup, which is what I recommend, highest probability of you passing a prop firm challenge, then go ahead with that. The other way is conservative. Conservative being you risk 0.5 to 1% per trade, but that will take you 3 to 6 months past phase 1 and phase 2 even. I have not tested for that long, but I can guarantee you if you do the high risk setup, you can pass challenge fairly quickly with this system. Thanks for watching this, guys. Let me know in the comments how you find this system, and if there's anything you would like me to change about it and do a backtesting session on it, a much in detailed one.